What exactly is a SOX control, and why is it such a key concept in auditing and compliance? Let's start with the basics. The Sarbanes-Oxley Act of 2002, commonly known as SOX, is a landmark United States federal law introduced to restore investor confidence after a wave of corporate scandals involving financial fraud. Think Enron, WorldCom, and Tyco. These scandals shook the market and exposed serious weaknesses in how companies were reporting their financials. To address these gaps, SOX made it mandatory for public companies to have strong internal controls in place over financial reporting. These controls ensure that financial statements are accurate, complete, reliable, and free of material misstatements. Now, what are SOX controls? Simply put, SOX controls are internal controls that directly impact the accuracy and integrity of financial reporting. But not every internal control in your company qualifies as a SOX control. Only those that meet specific criteria fall within SOX scope. To identify a SOX control, ask yourself 3 critical questions. Does this control impact information disclosed in financial reports or filings? Does it influence financially significant accounts or line items, like revenue, expenses, or assets? Is it tied to systems or processes that feed into financial reporting, such as enterprise resource planning systems, reconciliations, or journal entries? If you answered yes to any of these, that control is likely in scope for SOX and must be documented and tested regularly. But what happens next? Once a SOX control is identified, it goes through rigorous testing, usually done by management, internal audit teams, or external auditors. The purpose of this testing is twofold. First, to ensure the control is properly designed, meaning it's logically structured to prevent or detect errors. Second, to confirm it's operating effectively in real life, not just on paper. If a SOX control fails during testing, it could lead to control deficiencies, or worse, a material weakness, something that could potentially mislead investors and damage the company's reputation. That's why getting SOX right is so important. And today, many organizations use specialized tools like Audit Board's SOX Hub to manage their entire SOX program. It helps centralize documentation, schedule control testing, track deficiencies, and streamline SOX reporting, saving time, reducing risk, and improving compliance. To summarize, SOX controls are the backbone of trustworthy financial reporting. They help ensure a company's numbers are accurate, systems are secure, and processes are transparent. And that's what builds real confidence with auditors, investors, and the public. Credits script by Mayuri for Audit Decoded.